If you don't know what you're doing, it's a jungle out there.
Now let's have a look at how the money comes in to the company, to the business, and how profit is created. One thing that we have to know, very, very important. Confucius said, don't get confused. Don't get confused with this. In business, you put in small money. What you want is big money out. Small money in, big money out. That is the goal of business. We are in business to do what? Make money. Now, the money that comes in comes from two main sources. First, the owner. The second source is the lender. When the owner brings in money, accountant call it capital. Capital is money brought in by the owner. If the owner doesn't have enough money, he goes to the bank. Any lender who lends in money is called loan. Now let's have a look. For example, if we put in 200,000 as capital, there is a cost of using them. Whether the money is yours or whether the money is borrowed, there's a cost. If you put in 200,000 here, you have lost some opportunity cost. Your money could be sitting in the bank earning you interest, or could be in another investment earning you income. But since you put it in here, this income here must be more than what you receive from the bank interest or from the alternative investment. And then let's say here, if you put in, you receive a dividend. Dividend is nothing but the cost of using the owner's money. If dividend is 15%, the cost of using capital is 30,000. Now if you borrow 100,000, there is also a cost. That cost is now called interest. Interest is the cost of using other people's money. So in business, you either bring in your own money or other people's money. So let's ask again, is borrowing good or bad? Now here, it depends on whether you borrow to invest or borrow to consume. So here, the cost of capital, 15%, cost of loan, 15%. Now the accountant has got a term called total capital employed. When they use total capital employed, it now says the total funds that come into a company. Here is 200, there's 100, the total capital employed is 300. Now the word capital is quite loosely used. This is called equity capital, this is called loan capital. Now the total capital employed is 300. The total cost of capital is what? 30 plus 10, which is 40,000. There's a term called WACC, which is weighted average cost of capital. The weighted average cost of capital is arrived at by taking 40,000 divided by 300,000, which is 13.3%. And it makes very good sense because the cost of equity capital is 15%, the cost of loan capital is 10%. So the average, weighted average cost is 13%. Now this is very important. Warren Buffett talks about durable competitive advantage, your return on investment, return on equity. Here your return on your investment, ROI, must be more than your cost of capital, 13.3%. If you earn anything less than 13.3%, then you are not actually making money. The money that comes in here goes into what we call a working capital. Comes in here, that working capital produces a product which eventually ends up into money. Here, very important, we notice here, cash becomes, through the process of business, became a product, goes out, become money. This is called the cash conversion cycle. Cash coming, it takes time for it to become small money to become big money. Now, it stays here for production for a little while. When a product is produced, it does not become cash immediately. It goes into the storehouse and sit there as stock. Now, if cash is blood, blood must flow to keep the system moving, to keep the body healthy. Now, is this blood moving? This blood is not moving. This is, product is what? Product, as we said earlier, is money in another form, or what we call money in disguise. If you have $1 million stock, it's almost similar to that. Taking $1 million, go lock it up in the warehouse, sitting there. As it is sitting there, it is costing you your weighted average cost of capital. So that's why you hear very often accountants say, keep your stock low. Because if you have high stock, you have low cash. It may sit here for 3 months. Here, 1 month, 3 months. The cash conversion cycle is now 4 months. Now when it goes to a customer, and customer who hasn't paid you, credit sales, you may state that this customer, money that is sitting there is your own money, but now sitting in the customer's bank account. This blood is not moving. This is again what? A blood clot. Here, you again are charged the weighted average cost of capital, which is 13.3. I call it whack. You get whacked here, and you get another whack here. That's why accountants say, reduce your stock, reduce your, without high stock, high debtors, reduce your cash. Without cash, your ability to perform goes down. Now, let's look at this working capital. What is this working capital? Working capital is money required to finance your customer, debtors. If you look at this, what is this? Stock. Stock is money required to finance your stock sitting in the warehouse. And you have need cash here to run your operation, your business operation. And if you look at this, what is this? This is cash, debtor, stock. These are 3 elements of business, which is current asset, which I call working capital. So most of your money must go in here. If for a company which is have long, durable competitive advantage, most of the money must be in here to produce more money. So money goes into the current asset. The money that comes in from here also go into what we call fixed asset. High technology company has got high fixed asset. What is fixed asset for? Fixed asset is there to help working capital to produce. What are they? They are building, mainly plant equipment, motor vehicle. Why do you need building, plant equipment, motor vehicle? This is to help working capital. If this does not support working capital, you go back to your company, watch all the fixed asset. If they are not used, properly utilized, to help working capital to make more money, it is nothing but a blood clot. One of the biggest blood clot is when money comes in, business people go buy a big car. Nothing wrong with the car, so long as that car helps working capital to create money. Most of the time, that car only boosts the ego of the owner. It is a big blood clot. Now, here, money comes in, current asset. Money comes from where? Owner. Owner, capital. Lender, loan. It goes in, current asset, fixed asset. Some of the money goes in here as cost. What is this cost? You have accountant, You have stationery to be used. This cost here is direct cost. Cost of running the business. This is cost to support the business. Human resource, IT, sales, they are all telephone, marketing, they are all in support of this. Now, if you have this cost, and if they are not supporting those working capital, what are they called? Blood clot. Go back to your company and see if there's any blood clot walking on two legs. One blood clot just walk past. You know what? These are, if you employ anybody who does not support, they are blood clot. Where does this go? This goes into the profit and loss account, operating costs. There's one more up here. I call them angels. These are your suppliers. These suppliers provide you with material here, raw material, stocks, provide you with some equipment, provide you with stationery, telephone. Your staff provide you with service. Do they charge you interest? No. Capital has got a cost, loan has a cost. Angel, suppliers of labor, supplier of stationery, they do not, suppliers of operating expenses, they do not charge you interest. Therefore, I call it an angel. Free blood transfusion. So, this angel comes into here for current asset, creditors. So, now if you look at here, there are three main sources of finance. Who finance you? Owner, lender, and angel. And these are in the asset called liabilities. So again we come to the question, is liability good or bad? Without liability, you will not have asset, you will not have current asset, no fixed asset. Liabilities are the source of finance. And once the cash come out here, the income goes into the profit and loss account, less your cost, now you have profit. The profit that comes out here pays your interest. Profit after interest, there's one other person who doesn't have anything to do with your company that require, they provide you, they say infrastructures to run the company. This is the government, which is tax. After you pay tax, if anything's left, you pay dividend. Whatever is left goes back to the company as return profit, what somebody call it, profit that is brought into the company for growth. So, very simply, if you look at this chart, money only comes from three sources: equity, capital, long term. And these are listed in the profit and loss account or balance sheet as liability. And the application of fund is current asset and fixed asset. We come back to the same question. Is liability good or bad? Is borrowing good or bad? Borrowing for investment is good. Borrowing for consumption is definitely bad.